Yeah, it's a good time to check what we've done so far and still connect it to where we are, the next thing we want to do, and the topics that are ahead of us that we have to cover, right? So let's do a quick flashback. Remember what I said about your syllabus. I said your syllabus, you can divide it into 3 major groups, yeah? And that's looking at the current situation, your plan for the future, and how do you measure the results of your plan? Because when you plan, you will get an actual result, right? So when you have the actual result, then you're meant to compare your actual result with your plan. And with that, you will know whether your plan is good or whether you've been able to achieve your plan, or maybe even your plan is unrealistic, which is very possible, right? So this is your syllabus, yeah? And whatever you are trying to do here, you need information to be able to do it. And that's why everything is linked to information system, which is your section A of the syllabus, right? You need data, you need information to do everything. Analysis of your current situation is your costing. Yeah, and you remember, we already looked at everything on costing, which are those methods you can adopt to do costing. We looked at ABC, we looked at throughput accounting, we looked at target costing, life cycle, and environmental accounting. Yeah, remember all of this. And we've dealt with all of this, all done, right? So current situation has been dealt with. Now we've moved as well into the plan for the future. And your plan for the future, if you remember, I said you can look at it in 2 dimensions. The first one is the fact that you have to definitely take decisions. And likewise, you need to set targets. Yeah, and measuring results is your section E of your syllabus, which is about performance measurement, transfer pricing, and all of that. Yeah, this is your section B of the syllabus. This is your section C and D of your syllabus, right? So, and we are looking at this decision making. Yeah, here you are talking about how do you take decisions such as, oh, should we do a business? Should we even expand? Should we shut down? That decision is what we dealt with when we dealt with relevant costing. Because for you to be able to take such decisions, you need to know the costs that are attributable to those decisions. And if you're able to do that, then you can tell whether it makes sense to go ahead or not, right? And likewise, even when you are trying to take those decisions and you are planning, what are your limitations? And we dealt with that when we did limiting factors. Yeah. And we've dealt with relevant costing, we've dealt with limiting factor. And we also said that as part of our planning for the future, we must be able to answer 1 question or 2 questions. The first one is the fact that how many units of our product do we need to produce for us to be profitable? Or how many units do we need to produce for us to achieve a target profit? CVP analysis, cost volume profit analysis, which was what we actually just finished. When we're looking at how many you need to break even, how many you need to make a particular profit. That was all we're doing. We're planning for the future because we need to be sure before we go into that production, we need to get all those information right? And once we're able to do that, we know the units. Revenue, is it just units? How do you get revenue? Yeah, revenue is price and quantity, right? So if revenue is price times quantity, we want to be profitable, which means we need to know our revenue. We already understand our cost here, right? So, and we need revenue that will cover our cost so that we can be profitable. We know the quantity through our CVP analysis. What is next? We need to deal with price. And that's why the next thing that we need to look at is our pricing decision, which is what we will start today, right? So we're going to start with pricing, but After then, there's still more to do because we need to look at the risk that is associated with our plans. Remember, your plans will never be your actual. We touched part of this when we're looking at this CVP analysis. Yeah, when we used the margin of safety to see how much space, how much allowance, how much cushion do we have, yeah, between what we have budgeted and the point where we have to break even. Because anything that happens to our cost in terms of increasing the cost by that margin of safety will bring us to a loss position. Or if we lose our revenue by that same amount, we'll go to a loss-making position. So, and we'll look at similar stuff again when we get to that risk. Yeah, and once we finish that, the next part will just be to look at how do we set targets. And in that area, we'll be looking at things around budgeting. How do you set budget? How do you manage budget? Quantitative analysis, variance analysis, and all of that. And lastly, we go into performance measurement. That is the syllabus again. And see how far we've gone. We are more than halfway gone, for sure. Yeah, we have these two left now for decision making, then we'll go into budgeting, then we'll finish it at C and D is the most important. Those are the most important part of your syllabus. And that's why those are the areas where we've been spending a lot of time. Any questions so far? Okay, so now we see where we are, which is what I want to bring out, pricing decision. That's where we are. And we're going to start with that. Pricing decision. So like I was saying, we already understand, we have a good understanding of what our cost is. Yeah. We know the units from our CVP of what we're going to produce and sell. Yeah. What we want to do today is to know what price to charge. How do we determine the price to charge? We can't charge just any price. We need to charge a price that gives us profit. Yeah? And such price must be able to cover our cost. Right. And there are three methods that we can use to determine that price. The first method is your cost plus method. The second one is a market-based approach. And the third one is your demand curve. You can use that demand curve to get the appropriate pricing. So these are the three methods that we will look at. Yeah. I hope we can finish it today. Yeah. If not, we'll continue tomorrow. So let's start with the first one, cost plus. Has anyone heard about cost plus before?
Yes, sir.
Yeah, go ahead. Tell us about it.
It is basically the opposite of target costing. Here we start with the cost that the business is incurring. We add our margin and then we get the sales price.
Okay, very good. Yeah, yeah. And I'm happy that you use the word margin because we're going to touch on that today as well. Yeah, because going forward, you will know that you shouldn't use the word margin the way you've said it, right? So we need to now be very specific as to where do you use margin and where do you use markup. Yeah, because if you are talking about you knowing your costs and you want to add something on top the cost, you don't use the word margin. You call it a markup. Right. If you're using a selling price to determine your profit, then you can be using the word margin. And we'll get into that because it's been the word margin has been seriously abused. Yeah. Everybody says, oh, get your cost, put a margin on it, and that's your selling price. The idea is correct, no doubt, because when you're talking about cost plus, the first thing you want to do is you want to start internally with this question, yeah? Which is, what is the cost of producing the item? That's the first question. That's the first thing you want to determine. You want to know your cost, yeah? And yeah, definitely, this your cost can be determined by so many ways. And if in exams, they will tell you the method that's being used. Yeah. This course that we are talking about, you can use different methods to determine it. And we've dealt with so many types. All of them we've dealt with actually. Yeah. Your basis of determining your cost can be total cost. Yeah. Sometimes a company might decide to focus on marginal cost. What's the difference between total cost and marginal cost? So your total cost is your fixed cost plus variable cost. And just like Usman said, when you're talking of marginal cost, it's just the variable cost. Your marginal cost is the same as your variable cost. And that is why your marginal cost, like Ambia said, is the cost of producing one extra unit. And that is why it's usually variable cost, because fixed cost is already a sunk cost. So if you want to produce one extra unit, fixed cost is not relevant. Is labor cost and material cost that you will incur because of that extra unit, right? The other method you can use to determine your cost, you remember we did something on relevant costing? That can also be used. Yeah, similar to opportunity cost. Or the basis can even be hybrid, which means a company might decide to merge 2, 3 methods because they just want a lot of profit. Depends on what they know about the market or what they think they want to do. They can decide to just stay on marginal cost. Let me ask you, what do you think will make a company wants to use a marginal cost instead of total cost? Take, for instance, you want to do cost plus markup of 10%. But you're saying this cost, I don't want to use total cost, but I want to use marginal cost. Why? Because remember, you're going to make more profit if you use total cost as base because your selling price will be higher. Yeah. So this will give you more profit. This will give you less profit. But why would a company might want to use this kind of costing basis to determine its price? What about if you have a situation whereby the market is extremely competitive and you can't charge, you have to be careful with your pricing. If you are ever going to stay in that market, you know that you can't charge total cost plus. You have to be dwelling and relying on volume sales, which means any product that can just give you price above your MC will give you what? A positive contribution. And once you have a positive contribution, it's good to go. Keep producing that item at that low price, and you'll be able to sell a lot of volume that will eventually cover your fixed cost. So it's possible that it's a marginal costing method you want to use because you can't charge too much high price in such a market because it's highly competitive. So if your price is high, you are out of the market. So you need to be thinking in all these scenarios that we are putting down, what will make a company use those kind of, even if it's not in your literature, even if it's not in your exam, it's part of you being that awesome person in terms of your profession, your career, and everything you want to do. Think beyond what you're studying. Yeah. So step one is to determine that cost. And step two is just easy. It's just to add desired profit. Yeah, and clearly this is the opposite of target costing, because target costing, you start with the selling price that is market is able to buy your product. You deduct your desired margin, then you produce based on the balance, which is the remnant of cost that you have left. Yeah, so we are working in the opposite direction. So the desired profit is now the next question, which is how do you get this desired profit? Remember, for cost, how we said it can be different methods: total cost, marginal cost, relevant costing, opportunity cost, or hybrid. Then add profit to the cost. How do you get that profit? Now, this is the concept of markup or margin. These are the two ways you can use to get your desired profit. Yeah. And how do you get your markup? Please pay attention. This is another revision of this concept because I know for sure that you've done this in MA, but I still appreciate the fact that people still mix them up and get confused with them. Yeah. So markup is profit that you want divided by the cost. Yeah, times 100% for sure. But margin is different. Anytime you hear margin is divided by selling price. And that's why even if it's contribution margin, is contribution over selling price. If it is profit margin, it is profit divided by selling price. So is either we're going to get our profit from markup or from a margin. So if we want a markup, we know that definitely we just need to add our markup to our cost, and that will be our price. Because by the time we do price minus cost, remember your profit is equals to your selling price minus cost. So if we know our profit, we know our cost, we know that the selling price that we are looking for will surely be equals to profit plus cost, because this is our selling price. So this is your step one, and this is your step two. Any questions so far? Okay, so let's do something quickly. So if your margin is 20% and selling price is 50, what is markup? So if margin is 20% and you know your selling price, the first thing you know that you can calculate is you can get your profit from that. And you know that your margin is equals to your profit divided by selling price. So if margin is 20%, it means that 0.2 equals to the profit that you're looking for divided by 50. And with that, your profit is equals to 0.2 times 50. And that's $10. If you know your profit and you know your selling price, you know your cost, because you know that profit is equals to selling price minus cost. So which means $10 is equal to selling price of 50 minus cost. And costs will be equals to 50 minus 10, and that's equals to $40. If that is your cost, I asked you to calculate markup, and markup is profit over cost. Yeah, and in that case, that equals to profit is 10, cost is 40, and that is 25%. It's very important you're able to do this operation. I know you probably have some strange formulas on how to calculate markup from margin. Please don't memorize that shit. Don't do that. It's just the simple workings you can always do. You can always calculate your profit from a margin, profit from a markup, and you can use this understanding to link them together. The fact that you always know that your profit will be equals to price minus cost. right? Don't memorize any formula. The only formula you need to memorize are just these two formulas. Okay? Markup and margin. Which percentage do you think will always be higher?
I think markup.
Yes, please note, markup will always be higher than your margin because markup is always on cost and margin is always on selling price. Selling price would always be bigger than your cost because for you to be profitable for sure, you have to be selling at a price that is more than the cost. So if you look at the two ratios, they have the same numerators. The numerator is the same thing, profit. Yeah. However, selling price will always be higher than the cost. And in that case, this ratio will always be bigger. So in case maybe you are even in exams, you are calculating margin and markup, and you're having a markup that's less than your margin, then you know that you must have made a mistake because markup must always be higher than your margin. Please take note. Now, let's talk about suitability of cost plus. When is it suitable to use a cost plus method of pricing? In what circumstance? The first one is when you have a unique product. Yeah, maybe there's no existing market as well for it. And you know what that means? It means that you're controlling the market. It's almost like a monopoly, right? So in that case, you can decide to cost everything that you are spending on that product, add whatever you want on it, and dictate to the market that this is the price I'm going to be offering this product for you guys. You can do that if it's unique. And also, if the product is simple, and simplicity in the sense of costing, please take note. So which means it's easy to be able to accumulate the cost of that product. It is not a complex product that goes through different types of processes, joint production, all of that. Because if costing is difficult, then you might not be able to get accurate costing. And if you cannot get accurate costing, you shouldn't use cost plus method. So you use cost plus method because the product is simple and costing is straightforward. Please take note. Yeah.